Hey everyone, it's Hamish from the Young Investors Podcast. Myself and Brandon are excited to bring you your weekly rundown of the latest business and investing news from around the world. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing, make sure you reach out to a qualified financial advisor. But with that said, let's get into another episode of the Young Investors Podcast.
Right, everyone, welcome back to yet another episode. Hamish, what's going on, my friend? Back again, as always.
Back again. It's been a good week. I was fortunately able to go on Tom's podcast, Investing with Tom podcast this week, which was super exciting. We had a lot of interesting discussions around. We spent a lot of time talking about kind of YouTube and the finance space on YouTube, which was good. It was just a kind of a change of pace. We spoke about investing for a fair bit as well, but it was good to kind of talk about YouTube and business building, which is obviously something that I'm also quite passionate about, you know, as adjacent to the investing. So yeah, it's good. And it's available now.
Nice.
So go check it out.
Yeah, I just saw it pop up. It popped up this morning. So a couple of days old by the time this podcast goes out. I haven't had a chance to watch through it yet. So yeah, that sounds really cool. When's Tom going to quit his job and just do YouTube full time? Should we talk about that?
No, we didn't talk about that. I don't know. We need to nudge him towards
ramp up the pressure.
Yeah, for sure.
Nah, he will for sure.
Yeah.
He will for sure eventually.
Yeah.
I won't let him not quit his job. That sounds very mean of me.
So
it would be so good if he was just doing YouTube with us full time. That'd be so cool.
Yeah, it's it's tough. It depends on your circumstances, and it is very volatile. So it can be obviously quite a tricky decision, but I'm sure you'll get there.
That's true. Very true. Hey, what are we talking about today?
We have a lot of banking news. The last couple of weeks, really, the world of finances has started to heat up a little bit. We had because we had the Guy Spear interview last week, which we did on the podcast. So we haven't covered any of the banking news that's been happening over the last 2 weeks.
Isn't that always the way?
Which is exactly right. We have like 4 weeks in a row we have no news, and then everything kind of happens all of a sudden. But you're going to talk about the SVB bankruptcy, which happened now I think 2 weeks ago. And then over the last weekend, we had the problems kind of moving outside of the US into a Switzerland bank, Credit Suisse, massive Switzerland bank who ended up actually needing to merge or be acquired by UBS, the largest financial institution in Switzerland. So a lot of interesting stuff happening. And it's been a very interesting time in the finance world over the last couple of weeks because it's just been there's just been constantly new things happening. So I'm sure we'll have lots of exciting stuff to talk about over the next couple of weeks.
Yeah, we've also got a little bit on what the Fed is doing in response to the banking stuff, and also what they're doing with interest rates in response to what's come out. And I think UK inflation data just came out as well. So we'll talk about that, but I think that's going to be a pretty big episode. We've got some questions as well, which we'll go through. Hopefully we'll get some time to go through. Definitely, if you do want to ask us a question for the podcast, definitely head over to the YouTube version of the podcast and just drop us a comment. You can ask whatever you like, and we'll chuck it in and talk about it in an upcoming podcast. But yeah, with that said, let's get into it, I guess.
Yeah. Today's episode is sponsored by Sharesight, which is an application you can use to track the performance of your stock portfolio. So you can bring in all of your trades either automatically by connecting your broker, or you can download your trades using Excel or do it one by one. And once you do that, it will track all the gains and losses in your portfolio. So capital gains, dividends. If you have dividend reinvestment plans, it will do those calculations for you. Currency gains, if you're buying shares internationally or you hold foreign currencies, that's a massive one at the moment with interest rate changes around the world and different things happening in different parts around the world. There's a lot of currency fluctuations, and it can be really difficult to track that without using something like Sharesight. And then you can also use Sharesight when it comes to tax time. So Sharesight generates up to 12 different reports that can be used at tax time to work out things such as capital gains, dividend income, and more. And at the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That site spelled SIGHT, sharesight.com/young investors. So use that link. You can sign up to a free plan that allows you to track up to 10 holdings, so stocks, ETFs, bonds, that kind of thing, for as long as you want. So if you have a relatively concentrated portfolio anyway, then you can just get away with with using Sharesight's free plan, or you can use that as kind of a way to just test out the platform. But if you want, you can also, of course, sign up to a paid plan for more features. And if you do that using our link, you'll get 4 months off an annual subscription, which is a great deal. So go check it out if you haven't already. And as always, for those people who have used the link when signing up and are supporting the podcast, a big thank you from the both of us.
Absolutely. Okay, SVB, here we go.
SVB, what happened? Give us the breakdown.
Buckle up, baby. Well, this is there's kind of two. So this banking, I don't know if you call it a crisis, but there's definitely two halves to it. There's definitely Credit Suisse, which sits over in Switzerland, and then the rest. That one was kind of different.
Yeah.
And then all the ones that we've seen in the United States, at least, there's been a few. I don't know how many. There's like 5 or 6 now. They're all of a result of a very similar issue.
Correct.
So we initially saw Silvergate go bust. Then it was SVB. And then since, I think we've also seen Signature and First Republic topple as well. But out of all those, SVB, by far the largest bank failure. It's actually the second largest bank failure in US history after Washington Mutual. And it's the largest bank failure since the GFC. So I guess the first thing to cover is what on earth happened, because it is a similar story across all these banks, and it's a result of a monster bank run.
Yeah, and
just especially SVB is just enormous, like a huge bank run. What were you going to say?
All I was going to say is it's certainly something that if you haven't learned about it, it's good to kind of understand what happened, because not only is it the second largest banking failure in history, it happened within 48 hours. It was very quick. It was not this, well, I mean, the bank had some issues for quite some time. If you look at its stock chart, it'd been falling for a while, but the problems really accelerated within a couple of days, and then bang, it was gone. So it is a very interesting case study, and you're right. It's a similar thing is happening across a number of regional US banks, but it is quite separate to what we'll talk about with Credit Suisse later. But take us through kind of how it happened.
Yeah, it's interesting. So it's a result of a bank run. What does that even mean? Well, when it comes to banking, how it works, our system of fractional reserve banking, you go and you put your money in a bank, you deposit money in the bank, and a lot of people think that, the bank just holds their money for them, just gives them cash for it, You just rock up and take your money out. That's not what happens in reality, because the bank tries to make money. So it gives you a little bit for keeping your money with them. And then what it does is it takes your money and it finds someone that needs money and it loans that money out to somebody else. And then obviously the person that's taking on the loan pays the interest rate and the bank makes its money. So in reality, while a lot of people just think that when they, there's a big vault somewhere and people just put their money in the bank and the bank sends all that cash down into the vault and it never gets touched, that's not how fractional reserve banking works. As soon as you put that money into the bank's saying, all right, I want to make money off of your dollars that you've given to me, so they give it out to somebody else. So in reality, like it's like the bank might hold 10% of the actual deposits in the bank. In fact, I'm not sure because I don't know banks very well, but I think the reserve requirement in the US during the pandemic was actually like canned completely. Do you know much about that?
I don't know anything about that. I know that typically it's around 10% is the typical requirement, but I don't know. I don't know anything about that through the pandemic.
As of March 2020, the reserve requirement for all deposit institutions was set to 0% of eligible deposits. So there you go.
Okay.
Yeah. Wowee. I didn't know that. So anyway, so that's how this system works. And usually, obviously, we've done pretty well with this system. The only time where this system can fall apart in a dramatic fashion is if all of a sudden a lot of people show up to the bank at the same time and say, I want my money right now. I want all of my money and I want it now. And that's what a bank run is. Something happens and it makes everybody get very scared, very nervous. They all show up to the bank, try and withdraw their money, and the bank has to say, look, I'm very sorry, but because everybody's trying to withdraw money on this fine, bright and sunny Tuesday morning, we actually don't have that money here because we gave it to that guy that just bought the house the other day. So that's how this system works, and that's how this system can fall apart. And this is exactly what happened to Silicon Valley Bank and those other US banks. So SVB, I've written, is an interesting case because it operates specifically in the technology and startup space. So because interest rates are so much higher right now, a lot of these startups, these negative cash flow businesses, they're not raising money, they're not taking on loans, they're not getting that kind of funding at the moment. They don't want to commit to big chunks of debt. So instead, they are withdrawing their savings, whatever savings they've got in the bank, they're kind of sipping away on that to keep their business going. So SVB had, I think, $173 billion in deposits in Q4 from all these businesses, these like startup technology VC kind of businesses. And I think they saw their withdrawals they rise to $10 billion during that quarter. So a lot of money kind of being withdrawn, being sucked out. So what happened then is because they have, like, to keep the bank going, they have to meet their withdrawals. So what they did is they said, okay, we've got quite a few people wanting to take money out at the moment. We've lent out a lot of that money. We can't get that money back because these loans go on for a long, long time and they'll get repaid gradually over time. So what do we do? So what they did is they turned to their big bond portfolio, their big stack of government bonds, and they said, okay, we're going to sell these. We have to try and meet these withdrawals. So we're going to sell all of our government bonds, and give people the money that they're trying to withdraw. In doing that, however, they had to realize a $1.8 billion loss. And that's because these government bonds were bought in a low interest rate environment. And now that rates have gone up, essentially they've just lost a huge chunk of their value. So this, of course, it doesn't matter if you just held the bonds to maturity because you just get what return you signed up for. You would get paid back, you would get your interest, and that's all good. But the problem is that they were forced to sell their government bonds now once interest rates have gone up and the value of their bonds had come down. So they had to sell them, and thus they had to realize a big chunky loss.
So
Jazz, something to add?
All I was going to say, this is absolutely the heart of the big mistake that SVB made that does separate them in a way from most other banks, is that they loaded up during 2021 on a lot of these really long-term maturity government bonds that, as Brandon said, they were too long-term, so they couldn't wait until they just got the money back from the government. They had to sell them in the open market at a 20-30% discount in some cases, rather than buying, a wide array of different maturing government bonds. They could have had some longer ones and some shorter ones. They just had a lot of long ones that they had to sell at a discount. And that is really the heart of, it's kind of one key component of the whole SVB kind of situation.
Yeah. So they had to realize this massive loss. They released their results, showed this loss. Investors weren't happy. It also prompted the company to try and sell or to try and raise $2.25 billion worth by selling new shares to obviously plug the hole that they'd just dug for themselves. So there was naturally, when this happened, there's a lot of concern at this point. The bank's looking a little bit shaky. They've taken huge losses. It was also compounded by Peter Thiel's Founders Fund also recommended that their clients withdraw all of their money from SVB while they still could. And this basically snowballed into all depositors losing faith in SVB. And in one day, so they had, just check, $173 billion in deposits at the end of Q4. In one day, SVB saw withdrawal requests of $42 billion. $42 billion.
It's an enormous amount of money, like almost a quarter of their overall deposits in a single day, which is astounding.
Yeah.
And that actually speaks to kind of one of the other key components at work here, is that because it was a startup bank, they had a very concentrated number of big clients, basically. I think they had about 40,000 depositors, which is relatively small for a bank. And you had all of these, you had a very concentrated base that were all VC capital backed companies, and all these VC capital businesses just started saying, withdraw your money now. And it really didn't take, it's not like millions of different businesses or individuals needed to withdraw at the same time. It was, quite a concentrated basket, and it is astounding. Yeah, that 42 billion number is crazy.
Yep. And that's one of the main reasons that, one of the main problems with SVB and why it could topple so quickly is because instead of having millions of, say, everyday American clients, they focused in on a niche, and that niche was what is now a very much, a struggling industry, a struggling sector, that being technology, young technology companies, startups, VC, and obviously that's all just sucking at the moment. And when they're all business clients and they all, there's not many of them, they all turn around at the same time and say, oh, pull the money, it just blows up in your face.
Yeah.
So yes, $42 billion worth of withdrawals in one day, and obviously they couldn't meet these withdrawals. So a day later, the FDIC came in and shut down the bank. So the FDIC, the Federal Deposit Insurance Corporation, is what it stands for, I do believe.
Mm-hmm.
So what the interesting thing, so what they do is they come in and they shut down the bank, and what happens next is that the deposit insurance protection kicks in. So depositors, the first $250,000 worth of funds are insured, so that gets paid out under this insurance system. But what's really interesting with the FDIC in this case of SVB is that this $250,000 insurance on your deposits thing. That's such a good, rule to protect Americans. It's a great rule for, say, JP Morgan or a Bank of America. They have millions and millions of Americans banking with them who generally don't have more than $250,000 in the bank. So that's where it works perfectly. It makes everyday people feel safer knowing that they've got their first $250,000 insured.
Yeah.
It doesn't work so well with a company or with a bank like SVB, which, as you were saying, Hamish, has predominantly business clients that in many instances have a lot more than $250,000 in the bank. And this was what was really interesting. The big surprise that came out of this was that 95% of SVB's deposits were not insured under this FDIC protection rule.
Yeah.
95% of the money held in SVB Bank, in Silicon Valley Bank, was not insured.
Yeah, that's it's crazy. And to put that in perspective, out of the four biggest banks in America, so your Bank of America and JP Morgan and a couple of others, Wells Fargo and I can't remember the other one, the amount of deposits insured is between 30 and 50%. For those. So it's still not, most of the deposits, which kind of makes sense, but a much larger base is. And then, you look at SVB and it's almost all the deposits are uninsured, which is crazy.
So this posed a question to the rest of the world is what's going to happen now with all these technology startups and small businesses just not having any money. And that, interestingly, prompted the Fed, the Treasury, and the FDIC last week to put out a joint statement saying, this is unprecedented, saying that they would in fact cover all of SVB's deposits, all of it. So not first $250,000 worth. No, it doesn't matter. We'll just cover all of it. Screw it. This is very, very unusual. I'll read what they said. They said, today we are taking decisive actions to protect the US economy by strengthening public confidence in our banking system. This step will ensure that the US banking system continues to perform its vital roles of protecting deposits and providing access to credit to households and businesses in a manner that promotes strong and sustainable economic growth. After receiving a recommendation from the boards of the FDIC and the Federal Reserve and consulting with the President, Secretary Yellen approved actions enabling the FDIC to complete its resolution of Silicon Valley Bank in a manner that fully protects all depositors. So that was pretty wild, and it's kind of like I guess you can kind of read it a couple of different ways. You can read it like, I suppose, the Fed is saying, no, it's fine, calm down, it's all good. Or you can read it like, is the Fed a bit worried about this?
Yeah.
If they're having to come in, and it's just like, this is like what? How many business clients did you say they had?
40,000. Yeah.
40,000, and saying, we better step in right now and protect them. Is like, are they worried about the strength of the banking system?
Yeah.
So there's a couple of different ways you can read it, I guess.
Yeah, it's an interesting situation because it's not really a bailout. Because shareholders will still lose and bondholders will still lose. And the thing is that it's not really an issue of credit quality either. It's not as if Silicon Valley Bank thought they had all this value in assets and it's worthless like it was in the GFC. All these mortgage-backed securities that were completely worthless. So the assets are there. They're just not liquid. They just can't convert on, say, the long-term government bonds. They just can't convert them. They have to wait till they mature. So it's like the Federal Reserve is like backstopping that until the money comes up. So it's not as if the Fed will actually have to print money. It's not as if this will add to the money supply over the long term, because eventually the assets will be converted to cash and essentially pay back the Federal Reserve. That's completely different from a situation where they're actually replacing asset value that was thought to be there, and that's what happened in the GFC. So it is not as it is a unique situation where it seems like this might be a reasonable way to go about it, especially if it prevents further contagion. But that's kind of that's kind of important to note.
The last thing I had to say, so that's basically what happened with SVB. The last thing I wanted to say is I was watching the FOMC press conference this morning that's what we'll talk about in a little bit when we talk about interest rates and inflation. But I've lost my spot. Jerome Powell spoke about why the decision was made to protect all the deposits. And he said, quote, "The issue was not about those specific banks, but about the risk of contagion to other banks and to the financial markets more broadly." He also, so that makes sense. They were worried about potential, ripple effects. So they stepped in and took decisive actions before those effects kind of came up. He also interestingly blamed Silicon Valley Bank management. He basically said that they left themselves exposed to massive interest rate risk and they didn't hedge at all, which is the truth. And that's what we're talking about with these bonds. That's why they had to sell them. And he basically just said they suffered a monster bank run. So like, too bad, so sad. That sucks. It's just an unprecedented bank run.
Yeah.
He said that SVB was an outlier in terms of interest rate risk and size of uninsured holdings, which I thought was interesting.
Yeah. Did you see that chart that Burry posted on Twitter? If anyone's curious, If you go to the Michael Burry archive, because Burry deletes all his tweets, so go to Michael Burry archive Twitter page, and it'll be one of the recent tweets. He showed a chart of with on one axis he had the interest rate risk, and the other axis was the size of uninsured deposits, and you can just see SVB is just way out on the curve, basically, separate from everyone else.
Top right you can go, I think, on the chart, whereas everything is like more center.
Yeah. So those banks that do have high interest rate risk, so they have a similar thing. They've got a lot of these long-term government bonds. A lot of them have a lot of deposits that are insured. So that's kind of been why they haven't failed. It was kind of a double-edged sword. It was, they have all this exposure and our deposits aren't insured, so we better get our money out. And it's the combination of those two things that caused it to kind of run so quickly.
Yep. He also got asked, very interestingly, Jerome, look here. The $250,000 rule's a rule, and now you've just said, nah, it's all right, we got you covered. So he got asked, does this mean that all deposits are safe, period? And to this, he kind of hesitated a little, and then he said, I'm not saying anything more than I'm saying. You've seen that we have the tools to protect depositors when there's a threat of serious harm to the economy or to the financial system, and we're prepared to use those tools. I think depositors should assume that their deposits are safe. Interesting.
Very
because
interesting.
you can understand why he would say this, because you don't, like, the problem, like, the problem with bank runs is that they can trigger other bank runs. Like, it's a crisis of confidence, and it's all psychological. Like, one person's pulling their money out of the bank. Oh, should I pull my money out of the bank? I go pull. Hamish is like, oh, Brandon pulled his money out of the bank. Should I pull? And it just like dung, 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 dominoes fall, and everybody's, and it's just the collapse of the financial system. So it makes sense that he's puffing the chest out, saying depositors out there should assume that their money is safe. But on the flip side, you got to be careful with a statement like that, because then you get banks on the other end of the spectrum, which are saying, sick. Federal Reserve's going to come to our rescue. Did you hear that? And he said all the yeah, all of them. Yeah, let's go buy some more Bitcoin or something,
Yeah, I think I think that's why it's so important that, like, because I think it makes sense that they should protect depositors. It's not fair that somebody gets that a management team takes too much risk and you lose your money. But there shouldn't be a repeat of the global financial crisis where the banks were actually bailed out. Like, shareholders survived in a lot of cases, bondholders survived in a lot of cases, executives didn't go to prison. Like, that makes no sense. I kind of get what they did with SVB, which is the shareholders got wiped out, the management team's been kicked out, bondholders are going to get wiped out, but the deposits are being protected. That is a little bit of a better approach. I mean, you could still argue that it's too much support. I mean, some people will just say, to the hell with it and let the bank fail so that they do better next time. But I'm not sure I go as far as that. But it is a very difficult situation because, ironically, by saying that he will protect all deposits, he'll probably Jerome is probably preventing the need to do that in the future. Whereas if he says, I won't protect the deposits, then he probably will need to, because people will panic. So it's kind of an odd situation where you kind of just have to say the protection is there and then you won't need to use it. Unless a bank does something catastrophically stupid. But I guess we'll
It's all psychological, isn't it? It's so interesting. It's all psychological.
It is, and there is that big distinction between these smaller regional banks, where there are a lot less of deposits insured. This is, it looks like this is far less likely to happen at a major bank. So, but it is an interesting situation that, we certainly didn't see coming. And even last year, so they do banking stress tests in the US, and SVB isn't involved in these stress tests. It's only a certain number of banks that are. But a lot of people are looking at those stress tests now, and there was really nothing said on interest rate risk in those tests. So if SVB had been included, a lot of people believe that the issues would have been missed by the stress test, which the stress test was put in place after the GFC to do this specific thing, which is to check the credit quality and run a number of checks to make sure that the businesses are in good condition, the banks are in good condition. So basically, we're now looking at the stress test and saying, wow, they really don't actually, there's something wrong there. Because it should have picked up SVB's issue. Yeah. But SVB wasn't even included in it anyway, but like that's a separate issue.
Interesting.
But yeah, this interest rate risk, it should be said that it is very distinctly different from the GFC. This is a completely different issue. And it really is just born out of poor management in a rising interest rate environment and them not really or figuring out what they should have been buying during a rising interest rate period.
Yep. Well said, my friend. And that is the story of SVB, Silicon Valley Bank. But, oh my gosh, the story doesn't end there.
No.
We go over to Switzerland.
Yeah.
And we get Credit Suisse,
and we've got more problems.
Dying finally, the bad boy of the banking world. Finally,
I mean that's the right way to put it. I mean, as Brandon said earlier, it's a financial institution that's failing. And I'll talk about kind of what happened with it, but it is a very different situation to what's happening.
Tell us about
in the US. So. To give a bit of a background, Credit Suisse is, or was, I should say, the second largest financial institution in Switzerland. They had 250 billion in deposits in 2022, and much more in years prior to that. They were kind of bleeding deposits for a while. But there's really kind of four key issues that kind of stacked together to create what I'm going to talk about and the troubles that Credit Suisse had over the weekend. They've had really poor banking strategy for over a decade. They've just consistently made mistakes. They've had several instances of poor risk management that have caused issues. There's been consistently declining trust from clients due to their mistakes on risk management. There's a number of fraud allegations that have had to go through the courts, money laundering. There's just the funny thing is, if you go on Credit Suisse's Wikipedia page, the scandals or controversies section is bigger than the business's history section. So that gives you an idea
it's
of.
So funny.
It gives you an
They
idea.
were caught up in Archegos. There was the green seal scandal.
That was
they
a couple
failed
years
to
ago.
stop money laundering by a Bulgarian cocaine trafficking gang. They were spying on ex-employees. It's like what are you doing?
This bank, if any bank had to go down, it's this one. It was a disaster.
And it's interesting when you say, oh yeah, whatever. But let's not talk about scandals. Let's just talk about business performance. Well, you don't understand. Like if you're the bank that's consistently, like actually consistently caught up in the scandals, then that is going to lead to a massive erosion in confidence from investors, which is why you see the stock price go down so much. But also just like depositors. Like imagine if you're seeing scandal after scandal after scandal, and you've got your money held up in Credit Suisse, you're like, oh my gosh, it's like, is this bank gonna like die or go out of existence for some of these scandals? So it definitely is. It definitely erodes confidence, which is not what you want if you're a bank.
Yeah, it is really interesting because it's not like if like Nike's on the brink of bankruptcy, it's not like that's going to change your mind about buying a pair of shoes at Foot Locker that day. Like, whereas if the bank is in a crisis mode, the customers change how they behave. They kind of start to withdraw their money, so it kind of accelerates it. But yeah, so those were kind of all the issues. And then the final straw, of course, was just the panic around US banks. So it's not as if they had the same interest rate issues. It was just all of the panic around banking caused an acceleration of withdrawals from Credit Suisse, which had been happening for a long time. Deposits dropped 40% in 2022. And as I said, they'd been kind of falling for a long time. Total assets dropped 30% in 2022. And their net loss on their earnings for 2022 was $7 billion US. So, they were basically a disaster. Last week also had the bank's largest shareholder, Saudi National Bank, announced that it had no interest in increasing its 9.9% stake. And he kind of said that, or they kind of said that it was due to not wanting to go over 10% for regulatory reasons. But the way that he said it was just hilarious. He was asked a question in an interview and he was like, absolutely not. And that did not help the confidence at all.
Did you like what Patrick Boyle said on it?
I haven't seen his full.
He said what was it? The chairman of the Saudi National Bank was like, absolutely not, which was absolutely not the right thing to say.
So
Patrick Boyle, he's so funny.
He is. His videos are great. He's a great content creator. If anyone hasn't watched his stuff, but. So there was a number of things, and the bank came out and said that they found material weakness in their financial reporting. There was just a bunch of things that kind of all of a sudden, exactly, the dominoes started to fall, and so that brings us kind of to last weekend. Swiss regulators met quietly with Credit Suisse and organised a $50 billion US dollar loan from the central bank. So they kind of met with them. And we found out about that over the weekend. But what we didn't find out about over the weekend, but we know now, is that they also told executives that they have to sell themselves to UBS before the Asian markets opened on Monday. So the Swiss regulators basically said, you're going to do this. And they basically told them to go ahead and do it. And they also did a couple of interesting things. One of them was the regulators changed the law so that the deal could be passed without shareholder approval, which is an interesting strategy, but they really just wanted to get this, as you say, kind of crisis of confidence under control before it spread across the rest of Switzerland and maybe even worse. So, the regulators really did everything in their power to say, nope, we're stopping this right now. We're not letting this go on any further. And that ultimately led to the acquisition, where UBS, the largest financial institution in Switzerland, it's a global investment bank, to buy Credit Suisse for 3 billion Swiss francs, which is 3.2 billion US dollars. And that might sound like a lot, but it was 60% below even the stock price on the close before the weekend on Friday. So it was a massive discount on even where the stock closed just on that day, which is pretty unheard of. Even if a business is in trouble, often the bid will come in above or around the price of the stock. So the fact that the bid came in way below shows you how desperate the situation was. And to give it even more context, that 3 billion purchase price is 90% less than the value of the stock a year ago, and 99% less than the value of the stock when it peaked in 2007. So,
pretty insane, isn't it?
Yeah, unfortunately, long-term shareholders have basically been completely wiped out.
And I don't know much about banks. It's not my area of specialty, but I was listening to a CNBC interview with Steve Eisman, who is one of the other characters in The Big Short, played by Steve Carell. And he was talking about, he didn't really go into detail, but he was talking about how he's looked into this situation. And it was like, if there's one thing I can tell you, like, UBS does not want to take over Credit Suisse. So I was like, that's interesting. But I guess that kind of makes sense. I don't know why. I don't know why that is. That's just what he said. He's a smart dude, and I trust what he says. But it's kind of interesting because, normally you would pay a premium to acquire a controlling stake or acquire a company. But they've in fact got like a more, like what you said, a 60% discount. I mean, the market cap was, like $7 billion, and then UBS is paying $3.2 billion.
Yeah. So
that's pretty remarkable.
Yeah. And if you think about it, I mean, they're buying they're getting control of 250 billion in deposits. I think it was close to 500 billion in assets and over $1 trillion in assets under management in their investment business. So it's it's an enormous amount.
All for 3.2 billion.
Yeah, an enormous amount of assets, which does just show how bad the liquidity situation was for the business for it to be in that case. But the Swiss central bank, the Swiss regulators stepped in and kind of forced it through, and they actually forced through one other change, which was really quite interesting. First of all, in the deal, so Credit Suisse shareholders will receive 0.76 Swiss francs in UBS shares, which, as I said, is about 60% less than the price on Friday. So shareholders will still retain some value, but owners of some of the bonds are getting completely wiped out. So there's a class of bonds called additional tier 1 bonds, and these are considered quite risky bonds. They're not secured. However, they still rank higher typically on the typical hierarchy of who gets paid out. So when a business is failing, it's the shareholders that are going to get paid last. So it kind of goes down the hierarchy.
Stone dead last.
Yeah, so certainly bond holders are before shareholders. That's why the returns are a little bit lower, because you're a bit higher up on the hierarchy. And at the top, you'll have kind of senior notes, secured debt, which might have specific assets, that are collateral against it. And then you might have unsecured bonds. Then you might have some of these additional tier 1 bonds that are kind of more risky. But then you have shareholders. So this is an unprecedented situation where the Swiss regulators have said the shareholders can survive. They're getting pennies on the dollar, but they'll survive. Whereas
they'll get something.
Whereas these bondholders, $17 billion worth, were completely wiped out.
They get nothing.
And that, interestingly, it was an interesting move. And it actually immediately sparked a sell-off of AT1 bonds all across Europe. So obviously there's other banks and other businesses that have these bonds against them. And all the investors in these bonds started to panic, thinking, wait a second, if Deutsche Bank goes under now, am I going to get wiped out before the shareholders? So there's this massive sell-off in AT1 bonds. And very quickly, the EU regulators came out and said, no, we won't follow Switzerland in this decision. So it was all a very complicated series of events where Swiss regulators did a couple of things that were unprecedented. They forced a business to merge with another business. They didn't get shareholder approval for it. And then they wiped out bondholders, or some bondholders above shareholders. So really interesting situation. And just to finish it all off, they ended up loaning, or the Swiss central bank loaned UBS $100 billion, $108 billion to give them a bit more liquidity. So we really don't know how this is going to...
A bit.
Yeah, a little bit, just a bit of money.
just a tad, just a smidge.
Yeah.
108 billion.
Well, yeah, it's going to be interesting to see what happens, because there's no clarity on what the actual financial situation of Credit Suisse or even UBS is now. It's so complex. So we just have to see, as more information comes out, whether the merged entities can survive, really.
Yeah.
But certainly a very interesting case to add on to the banking crisis that's already happening in the US.
Yeah, it is interesting. Obviously, it's all come to a head. Kind of, I mean, it is like a crisis of confidence in a way that's made everything come to a head. But it is interesting when you break it down, you see that like Credit Suisse is actually a fair bit different to, say, a Silicon Valley Bank or one of the other ones, a Silvergate or something like that.
Yep. Yeah.
But yes.
So
it's a tricky time.
Yeah, and
I'm gonna go. Hang on. I better go get my money out from the bank. I'll be back in 5.
Yeah.
It's very interesting.
We'll
should we leave that one there?
Yeah, and I think that you mentioned you mentioned a couple of the regional banks. I think that's all that's happened, at least as of this podcast.
As of recording.
Although another weekend is approaching, so we'll see if there's any panic over the weekend. These kinds of things tend to happen over the weekend when banks are closed because there's less room for panic. They can kind of explain what's happening without people running to the bank 5 minutes later. But so we'll see what happens over the weekend, if there's any more pain, potentially maybe across other regional US banks, but we really don't know. It's just a play-by-play at the moment. We don't, no one has any kind of crystal ball to see which one's going to be next, or if there will be any more.
Breaking news, Wells Fargo is being taken over by JP Morgan for $500 million.
For $4.
For $4.50.
Oh, dear.
Yeah. Shall we move on? I want to talk about interest rates, because it's I know that everybody just loves to hear about interest rates.
Well, this is an interesting one because...
Do you have a mortgage? But boy, do I have some crappy news for you.
Yeah. Well,
what were you going to say?
All I was going to say is it is an interesting one because, obviously financial conditions have seemingly gotten a lot worse. So everyone was wondering, well, what's the Fed going to do? Is the Fed going to ease now? Or is the Fed going to pause? Are they going to continue with their pursuit of getting inflation under control? It really, we've spoken about this kind of, rock and a hard place that the Fed is in between inflation and potentially economic conditions worsening. And we're starting to see, an actual challenge for the Fed to decide, because up until now it's been a lot of inflation but good economic conditions. Now it's reasonable amount of inflation and conditions may be worsening. So it is certainly an interesting data point to look at.
Yes. So what happened? I think Jerome, he just got a bit overwhelmed this time around. He's like, man, there's too much going on. Can we just do what we did before, please? And that's exactly what he did. No. The Federal Reserve raised interest rates by a quarter point, 0.25%, the 9th increase in a year, as it balances the long-running fight against inflation with the sudden tumult in banking. Yes, that's what you were just saying. Federal Reserve officials raised interest rates by a quarter point on Wednesday, the 9th. The 9th increase. Yeah, I have just said that. Why is it listed the same thing twice? That's silly. Okay, moving on. The Fed move matched last month's increase in size, lifting rates to a range of 4.75% to 5%. In one of the most closely watched decisions in years, as conflicting forces left investors and economists guessing at what central bankers would do. Man, they do well to make it sound exciting, don't they?
Yeah, I know. It's a spectacle.
Yeah, I know. Well, actually, no, tell you what, maybe it is a spectacle, because I was looking on the Federal Reserve YouTube channel, right? Because they put the press conferences up there, and it was released on YouTube 3 hours ago, and it has 224,000 views.
Wow, geez.
This is the flippin' Federal Reserve YouTube channel. This is not a Graham Stephan, This is not a Vox Media. This is a flippin' the Federal Reserve.
Yeah, it's kind of crazy.
224K views.
Yeah, it is one of those times where finance people are interested in finance, but you've also got other people kind of creeping in, being like, "Oh, what's going on with interest rates? Like they keep seeing them go up."
Yeah.
So you've got kind of this extra audience at the moment in finance, which is great. I love when there's more people interested in it. But yeah, it is crazy when you see some of those numbers.
Yeah, so I was just watching through the press conference on YouTube. There's a couple of things he said that stood out to me. He did comment, obviously, on the banking sector. He referred to what happened with the US banks as isolated banking problems. So clearly doesn't see much, just wants to ensure to everybody that they will bail out everybody no matter what. But no, it's just an isolated event or two. No. Now, the Fed and the Treasury created the Bank Term Funding Program to ensure banks that hold safe and liquid assets can borrow reserves against those assets at par. He was making clear that there is and will be ample liquidity in the banking system. He said, quote, "Our banking system is sound and resilient with strong capital and liquidity."
I've heard that before.
He also said they are... Sorry? Yeah, I've heard that. Yeah, exactly. Yeah. He said they are prepared to use all of the tools at their disposal to keep it safe and sound. On inflation, so also talking about inflation, he continued to reaffirm, obviously, that inflation remains too high and that the labour market remains too tight, which is correct. Activity in the housing sector remains weak, largely reflecting higher mortgage rates. Also noted that the unemployment, there was an unemployment low in Feb of 3.6%. Labour demand substantially exceeds the supply of available workers at the moment. And then what else? What else did I take out? More stuff on the banking sector. He said, "We believe events in the banking sector over the past 2 weeks are likely to result in tighter credit conditions for businesses and households, which will in turn affect economic outcomes. It is too soon to determine the extent of these effects and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing interest rate increases will be appropriate to quell inflation.
Right.
We now state some additional policy firming may be appropriate."
Yeah.
So that's interesting. Yeah, sorry, you go.
All I was going to say is just to kind of break down that, take that out of financial jargon for those who are interested. Tighter credit conditions is essentially what they're referring to, is essentially banks with this crisis and a lot more withdrawals happening from even safe banks. People are just panicking a little bit more with this crisis. Banks are loaning out less money at the moment, so they're providing less credit to other businesses and individuals just to protect themselves during this. So those tighter conditions essentially slow the rate at which money moves around the economy, and that has kind of a ripple effect that goes across the economy. And as he's saying, we probably haven't seen that play out yet. So he's just kind of pausing cautiously.
2 weeks isn't long enough?
No, apparently not. Unfortunately, in finance, these things take time to kind of ripple out. So yeah, he's just kind of being a little bit more cautious not to, add to issues that may be there, but we can't see them yet. But interesting to hear him say that for sure. It's a definite switch of rhetoric from the last 6-12 months.
Yeah, for sure. I think that's all I took out of it too. He's also said, guess what, Hamish? We have to bring inflation back down to 2%. The costs of failing are much higher. That was his last thing he said.
I'm very happy to have Jerome Powell in the position that he's in, because I know that other central bankers may have very well just not given that much thought or care towards inflation. It seems like Jerome really does recognize the issues that happened in the last big inflation crisis, and to not repeat those problems. And that's really important, because
that's exactly what he was talking about. I stopped the quote there, but he goes on to talk about the 1970s and how they saw if we don't do enough at the start, it just keeps going. That's kind of what he was talking about. So yeah, you're right. Yeah,
and that kind of, I guess, leads into that. If that's what all you've got to say on that, that kind of leads into the UK inflation data, which does give you an idea of a bit of a trickier situation than the US is in, and it's not necessarily just due to government policy or central bank policy. policy. UK has its own unique challenges, but it is certainly an example of a place that's definitely between a much harder rock and a much harder place than the US. So UK inflation data came in and saw a surprise increase. It rose to 10.4% year over year, up from 10.1% in January, and only just below the peak, which was a couple of months ago, which was 11.1%. The monthly CPI increase was 1.1%, which if you annualize that is 14% inflation. So UK inflation is back to running very hot. The quote here from the UK Office for National Statistics says, the largest upward contributions to the monthly change in both the CPIH and the CPI rates came from restaurants and cafes, food and clothing, particularly offset by downward contributions from recreational and cultural goods and services, particularly recording media and motor fuels. So you kind of had a bit of energy coming down, but food and clothing continuing to increase at a high rate. And it really is an example where the UK is in a much worse economic conditions than the US, and their inflation is worse. So it is very difficult for them to judge what do we do, because every time the government will want to increase their spending and provide more stimulus in a way, more to citizens who are in trouble. But the more stimulus they provide, the worse they make inflation. And the higher the central bank raises interest rates, the more pressure it puts on the government to reduce their deficit. But if they lower them, it's going to increase inflation. So it's this very, very difficult financial or economic situation. So it's just very difficult to. Well, ultimately, we know that you have to go after inflation, but it's a tough decision to make when you know that it's going to cause a lot more economic pain in the short term. So, yeah, that's what's happening over in the UK with their inflation.
Yeah, largest upward restaurants and cafes. Damn, the soy chai latte is getting me every time.
Just stop the avocado toast, guys. Stop it.
Yeah,
we warned you.
More.
We warned.
Yeah, we've only got 5 avocados left. No, they all come from Ukraine. Ukraine's the world's #1 supplier of avocados.
Ukraine avocados.
Oh God. No, I shouldn't really laugh because it is a pretty grim situation over there. But yeah. They are really in between a rock and a hard place. But hopefully things can get better soon. All right, Hamish. Should we do some Q&A? Can we end on a slightly nicer note?
Yeah, let's
do some fun, happy Q&A questions.
Yeah, let's get out of the economic news for a little bit. We'll do some questions. As always, if you have any questions that you want to ask for next week's episode, head over to the YouTube version of the podcast and just click on the latest episode and leave your questions as a comment. Or if you're on Spotify, it's even easier. Just scroll up below and you can ask your questions natively within Spotify. I'll ask you this one. Your content is awesome, guys. Well, thank you. Been listening for the past 2 years since the start of my investment journey and your gold, both YouTube channels as well. What's your top 5 free tools for investing?
I came up with 4. I don't know. I'm probably just forgetting something. I'm quite a forgetful person, so it just hasn't come to the front of my mind. I would say Dataroma is very, very helpful. Dataroma is a website. That's where when I do the 13F videos for all the super investors, I'm looking at Dataroma. That's where I pluck all that data from. It just follows 79 super investors, follows Moj Prabhai, Guy Spear, Warren, Charlie, Seth Clark, like all of them. And it just shows you, just summarizes their 13F activity, what they've been buying, what they've been selling, what their largest holdings are, what their portfolios look like, all the guru investors. So I really like that because as Moj Prabhai says, it's a good way to figure out what maybe you might want to look at or do a little bit more research on when you see, 4 super investors that you follow all buying the same thing. You're like, oh, okay, better do some research on that. So Dataroma is very helpful. For actual financial data stuff, I do like QuickFS, must be said. It's pretty handy, and it is free, and it's got basically everything on there. I also like Simply Wall Street. I am sponsored by Simply Wall Street, but that's not influencing my decision to say that. There, you can get up to speed quite quickly. Just get a general background of what a company is doing and what they're kind of which direction they're heading, up or down. just by looking at Simply Wall Street. But I think the fourth one, because I couldn't think of a fifth, and I'm sorry if I'm nicking your one here, is one of the best free resources is just the annual reports, the quarterly reports, like for investing. That's where it's at, you know? That's like, I don't know, a lot of people love talking about, oh, I need to find a stock screener, I need to find this, I need to subscribe to, you know, some Motley Fool or something that tells me what stocks to buy. I mean, the company filings, man. There's a lot of information in there. That's really, really, really handy information.
Yeah, I haven't used the stock screener and then gone on to invest in that company in a very, very long time. You know, that's not to say people, you know, a lot of people do use them and you can use them effectively, but there's other ways to go about it. I mean, I tend to just look at which industries I'm interested in, and you can just quickly Google the list of publicly available companies, and that's basically your screen, rather than screening for specific you know, financial figures. And then you find a biopharmaceutical company with good, you know, debt ratios, and you're like, well, let's figure out how to understand this. I'd never really kind of do that. But in terms of other resources, Ticker is a good one. Ticker and QuickFS are pretty similar. Ticker, to get, you know, to get like 10 years of financial data, you do have to pay for it, but it does have a bit more of a broader UI, but both are very useful. I use both of them, QuickFS and Ticker. Seeking Alpha, again, I should say these are all channel sponsors, but again, I go for sponsors with companies that I use. So Seeking Alpha is a great one I use it a lot to kind of invert my ideas. So there's a lot of analysis on, you know, positives and negatives about a company. So you can read other people's opinions and you can really understand what the negative arguments are and try and invert those, which is, you know, a big kind of Charlie Munger, Warren Buffett thing. So those are a couple of other resources I would add in there too.
Yes, very good. All right, let's do one more for today. Should we do this one? I'll ask this one to you. I've been a dedicated follower of your channels and podcasts for the past 3 years and have learned so much from your advice and experiences. Thanks, man. I'm currently 22 years old, and I think I share many similarities with both of you at that age. If you could go back in time and give advice to your 22-year-old self, what would you say? Are there any regrets or mistakes you would want to avoid, or any changes to your mindset that you would suggest? I would love to hear your thoughts on how I can make the most of this stage of my life.
Yeah, that's a good question. I think the first thing that comes to mind is, I think something that I've learned kind of consistently through kind of adulthood, I guess, is the importance of getting like the fundamentals of your life right and how much of a difference that makes to other things. Like if you're struggling with work or something else, go back to your sleep, go back to your schedule, your eating, your exercise, like those fundamentals. When I'm getting those right, everything else kind of just falls into place. So that's what I would, you know, 22 is only a couple of years back for me, but especially if I was going back to 18, let's say, where if I look back at what my habits and schedule was back then, it was horrifically bad. I would go back and say, hey, get these things right quickly, because as I've gotten those things right over time, other opportunities have popped up and I've improved in other areas. So that would be my like number one piece of advice.
Nice. I think a big one is obviously just like, please start investing and invest what you can afford to live without. So don't invest money that you need, obviously. But start investing and just block out the media. Just go in being like, I'm going to hold, you know, whatever it is, the S&P 500, for example. I'm going to hold it for 20 or 30 years. I know I'm going to make a killing off this. I just need to put it there right now because I'm 22. I just need to wait. And future Brandon will thank present Brandon. So that's obviously a big one. Just regardless of what you hear in the media, just get started with your investing. What else? I think if I had to talk to my 22-year-old self, maybe this is too like specific to me and who I was, I would kind of just tell 22-year-old Brandon, don't feel the pressure of having to be at a certain point by a certain age or having to do this. Oh, I'm 22. I have to go to uni. I have to get a 9-to-5 job or my parents will think I'm a failure or whatever, blah, 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 blah. I just think that like you don't really realize just how, I mean, I'm only 28. I'm not like 40 or something, but you don't really realize how young you actually are when you're that young. You kind of feel like, all right, I'm an adult now. Shit, I have to start doing adult stuff. I have to get my life together. You really don't. So, I think that a lot of days, like especially with what we do, like social media, for example, is so powerful. Starting your own business online is so powerful. And I'd almost say, look, if you're not someone that is interested in going to uni and doing a degree, just don't do it. Go do something you want to do and see how it goes. Yep. It's usually a great time for most people. I can't speak for everybody, but usually you're still fairly well supported by your parents when you're in your kind of early adult years. And it can be a time where if before you have a mortgage, before you have a wife or kids or whatever your situation might be, you can take a risk. And if it fails, it's not the end of the world, So, and sometimes those risks can pay off. I know, obviously starting a YouTube channel has certainly paid off, and that was a risk for me. So,
yeah, and I think looking back, the odds of us getting to where we were was pretty low. But I don't think I would have ever forgiven myself if I never took a chance on, seeing that and thinking, oh, I could do that, and then not doing it. Looking back, I would have just hated myself for not trying, even if it had not worked out. I think that's really important.
Yeah, cool. All right, shall we leave it there, Hamish?
Yep, let's leave it there. Thanks, everyone, for tuning in, as always, and spending a little bit of your Saturday with us. As I mentioned, if you have any questions for next week, you can head over to the YouTube version of the podcast, or if you're on Spotify, you can just scroll down below and ask your questions there. Thanks to Sharesight, as always, for sponsoring. Sharesight.com/young investors. Go check it out if you haven't already. Reminder, there is a free plan that you can try for as long as you want. So if you're interested and you haven't already, go check it out. Thanks, Brandon, for joining me, as always.
All good, friend.
And we'll be back next week to talk about which is the latest banking failure that happened. No, hopefully not.
Also, shout out to Owen and Kate. I like this jumper. It's very comfortable. Thank you very much.
See you guys.
All right, we'll see you guys next week.